Welcome to the 80/20 Investor's Guide to Investing for Beginners in 2025. Are you prepared to take control of your financial future in these turbulent times? With market uncertainties looming and risks of a potential crash becoming more apparent, now is the time to act. Maybe you've saved up some money, but with so many investing options, stocks, bonds, crypto, real estate, it's easy to feel overwhelmed. Add to that the fear of losing your hard-earned savings, especially as the global economy faces mounting challenges like rising inflation, geopolitical tensions, and unprecedented levels of debt. The situation becomes even more complex. When questions of leadership and fiscal responsibility arise, can the current economic strategies, coupled with a skyrocketing debt burden, truly stabilize the markets? It's hard to feel confident when so much hangs in the balance. But here's the good news. Investing doesn't have to be complicated. In this guide, we'll simplify everything and challenge the popular notion that investing education is limited to stocks and bonds. Instead, we'll broaden the definition to include a wide range of opportunities, sometimes right at your doorstep, that can help you build wealth and secure your financial future. You'll discover how to focus on the 20% of actions that drive 80% or even more of the results. This is the foundation of the 80/20 principle, a proven approach that allows you to grow your wealth without getting lost in unnecessary complexity. In today's volatile economic environment, investing smartly is more critical than ever. Inflation is eroding savings at an alarming rate, and if your money isn't working for you, it's losing value. Whether you're just starting out or looking to fine-tune your strategy, this guide will help you navigate the risks and opportunities of 2025, equipping you with the tools to build lasting financial security. Let's dive in and take charge of your financial future. Here's what we'll cover today. Number 1, the basics of investing and why it's essential. Number 2, consider what you need to know before you start investing. Number 3, how to get started with stocks and index funds, the easiest entry point for most beginners. Number 4, addressing common fears about investing, like market crashes or starting with limited funds. And number 5, unconventional investing, a powerful strategy to accelerate wealth by focusing on yourself or your business. By the end of this video, you'll have a step-by-step roadmap to start investing confidently and effectively in 2025. So let's dive right in. The basics of investing. Let's begin with the basics. What exactly is investing and why should you do it? At its core, investing is the act of putting your money into something with the goal of growing it over time. Think of it as building your own engine, one that you power up and in return, continuously generates cash. This cash can then be reinvested to make the engine bigger and stronger or used to create additional engine. It's a concept we call investing in cash engine, and it's a cornerstone of sustainable wealth building. Why is investing important? The primary reason is inflation. Imagine you've saved $1,000 today. If you keep it under your mattress or in a standard bank account, it might feel safe. But as inflation rises, the purchasing power of that $1,000 decreases. Here's an interesting example from Japan. For years, people stashed their hard-earned cash in mattresses, behind kitchen furniture, you name it, and still managed to grow their wealth. Why? Deflation. With deflation and effectively negative interest rates, the purchasing power of the yen increased over time, making cash a surprisingly smart asset. Now, with strong signs of inflation across Japan and other developed economies, the landscape has shifted. Holding cash not only erodes purchasing power, but also misses opportunities to contribute to economic growth. It's a powerful reminder that investing isn't just about personal wealth, it's about driving broader progress. Here's an example of the effects of inflation, the loss of purchasing power. Today, $1,000 might buy you a new laptop. In 5 years, with 3% annual inflation, that same laptop could cost $1,200. If you haven't invested, your money has effectively lost value. Investing allows your money to grow and keeps pace with inflation, or even outpaces it, at least in theory, because investing comes with its own pitfalls and unknown risks. How does investing work? When you invest, you're buying assets that either generate income or increase in value. Let's break it down with some relatable examples. 1. Rental property. Imagine owning a rental property. Every month, you collect rental income, providing a steady cash flow. Over time, the property's value might also increase, giving you long-term appreciation alongside the monthly income. 2. Dividend-paying stock. Certain stocks pay dividend, regular payouts from the company's profits to shareholders. It's like getting paid just for owning a slice of the company, creating a consistent income stream without having to sell your shares. 3. Digital income stream. Your own YouTube channel, for example, can generate monthly revenue through Google AdSense. Each video becomes a digital asset, earning you passive income as it accumulates views over time. And 4, appreciating assets. These are assets that not only generate income, but also grow in value over time. A prime example is land. Land is finite. There's only so much of it. As population grows and demand increases, so does the value of land. Now, there are many types of investment. Stocks. You own a piece of a company. Bond. You lend money to governments or corporations in exchange for interest. Real estate. Physical property that generates generates income or appreciates. Crypto, digital currencies with high volatility and reward potential. Index fund, a basket of stocks that tracks a specific market index. For beginners, a great starting point is stocks and index funds. They're accessible, scalable, and have historically been reliable for long-term growth. But here's the catch. This is the textbook definition of investment, a framework that clever Wall Street bankers established back in the mid-20th century to promote their financial products and services. While effective, it's a narrow and increasingly outdated view of what investing can be. We believe in broadening the definition of investments to include digital assets, which are approachable, simple in concept, and familiar to most viewers of this channel. Digital assets, whether they involve crypto, content creation platforms, or online intellectual properties, represent the future of investing. They offer opportunities to harness technology and creativity to build wealth in ways that go beyond traditional financial markets. The 80-20 principle. Remember, you don't need to invest in everything. Focus on the few investments that deliver the biggest impact, like index funds or blue-chip stocks. We'll dive deeper into these later. Part 2. Setting financial goals and choosing the right accounts. Before diving into the stock market or any investment, you need a game plan. This starts with setting clear financial goals. Why are goals important? Imagine going on a road trip without a destination in mind. You'd waste time, fuel, and energy. Investing without goals is the same. You risk making random decisions that don't serve your long-term needs. Ask yourself these questions. 1. What am I investing for? Short-term goals like saving for a car or wedding. Long-term goals like retirement or building generational wealth. 2. How much risk can I handle? Are you okay with the ups and downs of the stock market, or do you prefer safer investments like bonds? And 3. What's my timeline? Short-term investments may require safer options. Long-term goals allow you to take more risks for potentially higher rewards. From a tax and retirement planning perspective, other important considerations come into play. Once you've set your goals, the next step is choosing the right type of account. Here are 2 common options. Brokerage accounts, ideal for general investing with no restrictions on withdrawals. It is flexible, easy to set up, and suitable for a variety of investment types. Retirement accounts. Examples include IRA or 401k, which offer significant tax advantages such as tax-deferred growth or tax-free withdrawals, depending on the type. Keep in mind, these accounts come with restrictions on withdrawals before retirement age. For beginners, starting with a simple brokerage account on platforms like Vanguard or Trading 212 is an excellent option. These platforms are user-friendly, offer low fees, and provide a great introduction to the world of investing. Once you gain confidence, you can explore adding retirement accounts to your portfolio for long-term tax benefits. Part 3. How and why to invest in stocks and index funds. Now let's talk about stocks and index funds, arguably the best starting point for most beginners. How do stocks work? When you buy a stock, you're purchasing part ownership in a company. Let's say you buy shares in Apple. That means you own a tiny fraction of Apple Inc. How can you make money from stocks? First, stock price appreciation. If you buy Apple shares at $100 each and they increase to $150, you've made a profit. Second, dividend. Some companies share their profits with shareholders. These payouts, called dividends, are like passive income. Why are index funds ideal for beginners? Index funds are a collection of stocks that track a specific market index, like the S&P 500. When you invest in an index fund, you own a small piece of all the companies in that index. Why choose index funds? Diversification, proven growth, ease of use, low costs. Part 4. Addressing common fears about investing. Investing can be intimidating, especially when you hear about market crashes or people losing money. Fear. Number 1. Losing money. The stock market has ups and downs, but remember, downturns are temporary. Example, during the 2008 financial crisis, the market dropped significantly. Yet, by 2012, it had recovered and surpassed previous levels. The key is a long-term perspective. If you stay invested, you're likely to see growth over decades. Fear number 2. Not knowing enough. Many beginners feel they lack the knowledge to start investing. Here's the truth. You don't need to be an expert. Start small. Platforms like Vanguard let you begin with just $5. Fear number 3. Timing the market. Don't stress about buying at the perfect time. The most important thing is consistency. Regular investments, even in small amounts, will compound over time. Or just follow Warren Buffett, who once said that it's wise for investors to be fearful when others are greedy, and to be greedy only when others are fearful. Part 5. Fast lane investing. The 80-20 perspective. Let's shift gears to fast lane investing. While slow lane investing, like index funds, builds steady long-term wealth, fast lane investing accelerates growth by focusing on yourself or your business. Invest in skills. Imagine mastering the fine art of selling. It might take years to perfect, much like earning a lawyer's or doctor's degree, but with this skill, your financial future is virtually guaranteed. Sales are the backbone of every industry, and whether it's physical products or today's digital goods, The demand for skilled salespeople remains timeless. Regardless of economic conditions, this invaluable ability ensures you can generate cash, adapt to shifting markets, and create opportunities for yourself in virtually any field. Invest in your own cash engine. Building your own cash engine, whether it's a YouTube channel, a digital product, or a service-based business, can generate exponential returns, unlike traditional investments like stocks, where you aim for an average 7% annual growth. A successful venture has the potential for far greater profits, often with minimal initial investment. Examples of cash engines. 1. Launch a digital product. Create and sell an ebook, an online course, or software. Digital products have low upfront costs and high scalability. Once created, they can generate passive income with minimal ongoing effort. 2. Start a blog, podcast, or YouTube channel. Share your expertise or passion, build an audience, and monetize through ads, sponsorships, or subscriptions. Platforms like YouTube can turn your creativity into a consistent income stream as Google AdSense revenue grows with your audience size. And 3. Service-based ventures. Offer consulting, freelancing, or coaching in your area of expertise. These ventures require time up front, but can lead to exponential growth as you scale or automate certain processes. For example, consulting for small businesses can evolve into online workshops or subscription-based memberships. Applying the 80-20 principle. The 80-20 principle is critical here. Focus your energy on the few high-impact actions that deliver the most significant results. Instead of spreading yourself thin across multiple projects, identify the 20% of actions that will yield 80% of the results. For example, in YouTube, prioritize creating high-quality, engaging content over obsessing about every minor detail in editing. For a digital product, spend more time researching your target audience and their pain points rather than creating multiple products at once. Benefits of Cash Engine. First, scalability. Once established, cash engines have the potential to grow exponentially with minimal additional input, allowing for significant returns over time. Next, autonomy. You have full control over the direction, pace, and scope of your venture, giving you the freedom to shape your financial future on your terms. Next, diversification. By creating your own cash engine, you reduce reliance on traditional markets, adding an additional layer of financial security and resilience. Finally, low capital requirements. Many cash engines require very little initial investment and can often be bootstrapped. Bootstrapping means starting a venture with minimal external resources or funding, relying instead on your own savings, revenue from the business itself, or creative problem solving to grow sustainably without taking on significant debt or outside investment. As we wrap up, let's revisit the key points that can guide you toward financial success in 2025 and beyond. Traditional investing. Index funds and ETFs are the cornerstone of building long-term wealth. This approach is steady, dependable, and ideal for anyone seeking a low-maintenance, risk-managed way to grow their financial portfolio. These tools allow you to invest in virtually any asset class, ranging from traditional options like stocks, bonds, and real estate to more modern categories like cryptocurrencies. Additionally, many of these investment vehicles are tax optimized, providing further advantages for long-term growth and wealth preservation. Not only is this strategy simple and effective, but it also comes highly recommended by some of the greatest minds in investing history: Warren Buffett, John Bogle, and the recently departed super investor Charlie Munger. Their collective wisdom highlights the enduring power of sticking to fundamental principles and focusing on the basics for sustainable, long-term financial success. Unconventional investing. Investing in your own cash engine, whether it's a YouTube channel, a digital product, or a service-based business, provides unparalleled autonomy and the potential for extraordinary financial return. These ventures enable you to generate significant income streams on your own terms, diversifying your financial portfolio far beyond traditional markets. The best part? Many of these ventures can be semi-automated, eventually transforming into genuine sources of passive income. The 80-20 principle ties everything together, reminding us to focus on the small, impactful actions that lead to the biggest results. By zeroing in on the investments, ventures, or strategies that truly matter, you can create meaningful, lasting financial progress while avoiding distractions that waste time and resources. Take action today. The time to start is now. Don't let fear, uncertainty, or analysis paralysis hold you back. Begin by investing in your own financial education. Like any skill, your investing abilities will grow and evolve, offering you a clearer understanding of risk-reward dynamics, the administrative side of investing, and the nuances of personal and family tax situation. Remember, education is your most powerful tool on the path to financial success. The sooner you start, the sooner you'll be equipped to make informed, confident decisions about your financial future. Take that first step today. We'd love to hear your thoughts. What's inspiring you to start investing, or what's holding you back? Let us know in the comments below. If you found this video valuable, please like, subscribe, and and share with others who are ready to take charge of their financial futures. Check out our books like The 80-20 Investor or Death of Retirement on Amazon for deeper insight. Links are in the description, along with a sign-up for our free newsletter. Thank you for tuning in, and we'll catch you in the next video. Disclaimer: the information provided in this video is for informational purposes only and does not constitute financial or investment advice. Always consult with a licensed financial professional before making any investment decisions.